Hi. In this video, we're going to talk about the last of the less clear performance obligations talked about in the textbook. And then we'll turn our attention to some less clear transaction prices. So here's the last of the less clear performance obligations. It's customer options for additional goods or services. These options grant the customer an option to receive additional goods or services at no cost or at a discount. Common examples that you may be familiar with are frequent flyer miles, credit card points, and then software upgrade rights. From an accounting perspective, these are considered performance obligations of the seller if this option is considered a material right. If the customer option provides a material right not otherwise available to the customer. Here's the accounting. When it is deemed to be a material right, the seller will allocate a part of the contract's transaction price, the total revenue from the transaction, to the option. So they'll have sales revenue for most of it, but they'll also have unearned revenue and a contingent liability for the amount allocated to this option. And that's customer options for additional goods or services. Okay. Now let's turn our attention to several instances of less clear transaction price in the transaction. The first is variable consideration. This happens a fair amount. In this instance, the price will depend on the outcome of some future event. Common examples, manufacturing construction industry will have incentive payments. Incentives, for example, for meeting a deadline of delivery. The entertainment industry and the media will have differential royalty opportunities. Healthcare will have Medicare and Medicaid reimbursements that might depend on a future event. Manufacturing will have volume discounts and returns. Telecommunications often has rebates. With variable consideration, the seller estimates the ultimate transaction price and includes in sales revenue the expected value, the sum of outcomes multiplied by their probability, or the most likely amount. Okay, let's turn our attention to the right of return. This represents a potential failure to satisfy the performance obligation. Again, the performance obligation is that we deliver goods that meet the customer's desires. We've all done this. We've all returned a pair of pants that don't fit appropriately, that type of thing. Sales returns are estimated. And then the sales return, a contra revenue account is debited, an allowance for refunds liability is credited when we make the balance sheet and the income statement. So that, therefore, we don't overstate sales and for the amount of sales that are ultimately going to come back to us. It just hasn't quite occurred yet by the end of the fiscal year. This accrual is usually one of the adjusting journal entries at the end of the period, and it's usually done as a percentage of sales that occurred in the, quote, return window, when returns are still allowed. We'll return to this issue in the chapter on liabilities, the liability created by this return, the allowance for refunds. Finally, the time value of money can make the transaction price less clear. The time value of money is considered if the time to collection is significant. If indeed it is significant, the contract is considered to have a delivery component of the product and a financing component. The companies are not in the business of making interest-free loans. Thus, if they say, for example, buy this bedroom set and pay us in a year, well, what they've really done is they have sold the bedroom set and made a loan to the customer. The product or service delivery price is the value of that good or service, such as the bedroom set, in a collection at point of sale. So a significant time prepayment, such as 1 year, from the customer is treated as borrowing money from the buyer in the same logic. Delayed payment date by the customer is treated as a sale with a note receivable from the customer. So in terms of the time value of money, we've spoken about when the money is received early, and if it's a year early, if it's a significant time early, then we will consider this a borrowing. And then if we're giving the customer a delayed payment date, we're treating that as a sale of the good with a note receivable from the customer. So again, that's, for example, when you buy your bedroom set and they say no money down and then payment in a year, interest-free. Okay, and so those are instances of the less clear transaction price. Now in the next video, we'll speak of less clear fulfillments of obligation. Thanks for your attention.